Hey everyone, welcome back to Yuri's Box. In this video I'm going to talk about where are interest rates going in the US in 2025. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So you might hear my voice being a little bit deeper. I'm not trying to put on a flirty attitude. I'm just fighting through a sore throat. So, that aside, I think to answer the question, where are interest rates going across the curve, so the 2-year, the 10-year, 20-year, 30-year yield for the US, and where are they going in 2025, there's an important distinction that needs to be made. First off, the Federal Reserve doesn't really control interest rates on the long end of the curve, and really what the Federal Reserve controls is the front end, right? So think about bills, right? 1 month, 3 month, etc. Something like the 2-year yield that you have in front of your eyes right now. The way you have to think about the 2-year yield is that it is, in effect, the market's way of communicating with the Fed. Wherever the 2-year yield goes, eventually that is where the Fed goes. Now, it isn't a perfect instrument, like potentially we saw in these last few weeks where, the 2-year yield, declined rapidly, pricing in potentially more rate cuts and faster. And it kind of gave it all up, all right? So we've moved back to 4%, which is basically pricing in one rate cut. Granted, this is potentially polluted by, possible liquidations caused by who knows what. Basis trade is definitely one of the culprits. But just taking it at face value, I think that the 2-year yield, again, is the way at least I think about it is that it is the market's way of talking to the Fed and telling it where to position interest rates. Anything over the 2-year yield, it is just the market's way of pricing in growth and inflation expectations. If you have inflation expectations rising, like we saw at the end of 2021 and most of 2022 and 2023, you can expect rates to go up higher, all right? So 10-year, 20, 30-year, the positioning of rates is really decided by the market, okay? And again, it is based off of mostly, in my opinion, growth and inflation expectations. Now, I'll go in order, and I want to tackle for the Fed for first, all right? And really, the way you have to think about the Fed and what it's going to do with interest rate positioning, all right, is that you have to think about the Fed as not a preemptive actor, but as a reactionary actor. All right, the Fed doesn't tell you, the Fed doesn't act in a manner that anticipates events. The Fed reacts to events. And this is, you can see this clearly, in my opinion, in the Summer of Economic Projections that gets released each year in March, June, September, and December. And what they basically tell you in the Summer of Economic Projections is they basically say, if current conditions persist in the future, this is how we're going to react, all right? And the best way to visualize this, in my opinion, is the dot plot. I really mostly look at the dot plot. And why do I look at the dot plot? So what is a dot plot, first of all? Each dot on the chart is basically one participant's, it is an indication of each participant's expectation of where interest rates will be at the end of the year. Okay. So looking for what you have in front of you is, again, the SEP for June of 2024. And you have to roll back the tape a bit here. What was happening in June of 2024? Well, in June of 2024, we had just come out of sticky inflation, all right? It was everyone's expectation from October, and again, really even the Fed, because that's exactly what the Fed said, that if inflation, well, the disinflationary trend were to continue, then, we could expect rates to go lower, at least on the Fed side. And you saw, for example, things react to that, in my opinion, quite severely, because again, this is the monthly. What you see right here, November was a big rally, December the same thing, and you also see that on the 2-year, if I'm not mistaken, right here, November and December. You see big rallies across the curve because again, potentially, inflation is going to be well behaved, and so we can expect rates to go lower. However, from that point on, you see inflation be sticky. And so by the time we're in June, we're 3% on inflation. And so the Fed has to kind of walk back everything. They have to tell you what they're telling you here in the dot plot. Remember all those rate cuts that we were going to have? Yeah, we're not going to have any of those. And the way you can visualize that is look back at March's SEP and just look at how in March, you have, dots positioned in this manner right here, and look as they drift higher. All right. And the other example I'll make before I, move on to other things is what we saw after June. Because in fact, after June, inflation just continued back on its previous trend, meaning further disinflation. And in fact, right here in the middle, we actually had a growth scare. If you remember in, where is it? Right here. If you remember, we had a significant rally during the summer months, because of, more disinflation, number one. Number two, growth starting to look a bit shaky. And that culminated really with the July non-farm payroll report. August payroll report wasn't pretty either. And in hindsight, it was awful, given the fact that revisions actually obliterated the original number. But again, because, from June till September, we basically flipped the script, right? It's no longer inflation that we have to be worried about. We have to be worried about growth. Sure enough, from June's dot plot, where everyone was basically saying, remember all those rate cuts? Forget about it, man. We moved to September, after the growth scare, and we see everyone take the elevator down. Excuse me. Especially for 2025, right? You see how slowly but surely participants on the FOMC expect interest rates to be lower. And again, this gets reversed immediately in December. Because, again, what we saw from September till December is a halt of the disinflationary trend. And as a consequence of that, the Fed reacts to it. And it says, remember all those rate cuts we said in September? Forget about it. So it's really continuously flip-flopping about, what it's worried about. And in fact, I use, this simple principle that the Fed reacts to whatever it has in front of its eyes to point towards the fact that in March's SEP, we were to expect a somewhat hawkish, slightly more hawkish dot plot, and that is exactly what we saw. Some of the, I pointed towards these, these guys chilling around between 3 and 3.75 to drift up, and that is basically what we saw. All right. So to answer, what will the Fed do? In my opinion, you have to really answer the question, what is the economy looking like at this point? And what I've been saying consistently ever since I started making videos is, if you look at things like the quits rate, and again, the way I treat the quits rate, it is a survey. It is the best kind of survey you can have, because it is telling you what people are doing and therefore what they actually see in the economy. If people are quitting their job voluntarily, it means they see strength in the economy, regardless of the fact that they're Republican, Independent, or Democrat. And again, that means that the economy is strong if the quits rate is up. People have the ability to switch jobs easily because there's an abundance of jobs. And in turn, that pushes up wages, because you can switch jobs that offer you more. And the fact that you have other jobs offering you more gives you the possibility to go to your current employer and tell them basically to give you a raise, otherwise you're switching jobs. That's it. And again, higher wages feed into consumption, which feed into potentially higher inflation. If the quits rate is at cycle lows, as it is currently, you can expect the opposite. You can expect people, basically what people are telling you when they're not quitting their job voluntarily, is that they no longer see the abundance that they saw right here, and that they're staying put, and they're starting to lose a big chunk of leverage in the labor market, right? Which again feeds into potentially slower wage gains, which feeds into consumption, which feeds into lower inflation. On the inflation side of things, right, again, this is prior to all of the tariff drama, right? My expectation was that basically we would see a repeat, potentially, of what we saw in 2023, where I pointed out the fact that from October till March, you usually see inflation be sticky. And if you think about it, the reason for that is quite simple. If you have holiday season, if you have people getting their end of year bonuses, if you see people traveling more, spending more, consuming more, inflation is going to look potentially a bit more sticky. And again, you have the holidays to blame for that. I pointed towards this bump, that's what I called it, the bump from September till January, basically being a repeat of what we saw right here, because on top of having holiday seasons, basically, when everything that entails, that goes with, along with the holiday seasons, meaning more consuming more, you also had a few transitory effects, and yes, I'm using the T word. We had a few transitory events take place. You had port strikes, potential for port strikes in September. So everybody pulling forward, potential imports, production, etc. You had natural disasters in October and January. Tariff front running, because again, you had Trump basically tell everyone, I'm going to do tariffs, right? So you have tariff front running. And on top of that, you had the holiday season in between. So all of that, and really this is what I was trying to, make, the viewer think about. Think about the question and that was the real question that, in my opinion, needed to be asked, and it still needs to be asked. I think that the tariff drama has kind of distracted us a bit. Because in my opinion, and I go back to what I was saying before, what is the question that needs to be asked? Is what we saw right here from September to January the real nature of the economy, meaning something fundamentally shifted? Or is what we saw in the summer months telling the truth? Basically, who was lying between economic trends? Were the summer months just a fluke, a one-off, right? Just a meaningless growth scare? Or is this part of the economic cycle lying? And is this just a one-off caused by a lot of transitory events? Going into this, I leaned more on the side of this being, well, the liar, all right? So what we saw from September to January. And in fact, as we move towards the summer, you would see a repeat of the conditions that started to get highlighted during the summer months. And if you look at a wide range of, and again, surveys on the business side, ISM, S&P reports, they've all been telling the same thing. That potentially we are back in the summer months. Excuse me again. We are back in the summer months. And what does that mean for, as far as the point of the video is concerned? Rates need to be lower. And one of the first things I said is that while we were right here, right, this is where we were when I started making videos, more or less. We were at levels on the 30-year yield, on the 10-year yield, you name it, not seen since 2023 without the growth of 2023. Meaning, in my opinion, potentially rates are misplaced. They are too high for the real fundamentals of the economy. And eventually they'll have to face the music. Because another thing that I still believe to this day, even after all the drama that we had with tariffs, is that going into 2025, and I think it's important for everyone to remember this, going into 2025, we saw a repeat, in my opinion, of what we saw in 2022. All right, just flipped, meaning in 2022, from 2022, and I think the best way to visualize that is on the 10-year yield, for example. From here, October of 2022, till really May of 2023, and potentially June. Why did rates stay like this? Why did they stay flat? Because if you remember, in 2022, everybody was worried about a recession. Because the Fed overdid it. They hiked rates too much, and therefore they're going to have to cut a lot. And keep in mind, they were still hiking. They actually stopped hiking in August of 2023. All right? Right here. However, the market, faded that idea. And you saw expectations for a recession rise during this period of time. I think that we are in a similar situation as 2022, flipped, meaning that right now, going into 2025, what I saw is people be optimistic on growth and pessimistic on inflation. And my assumption, or really my speculation rather, is that you really have to be exactly the opposite, meaning a bit more worried about growth. And again, I'm not saying depression style, I'm not hinting at depression. I'm saying that everything I look at, and I've looked at so far in my videos, have been excuse me, I'm doing my best here, have been pointing to the fact that potentially growth has been slowing. Potentially we are in a slowdown regime. That slowdown doesn't mean recession. It still doesn't mean recession, and it definitely doesn't mean depression. It means that the economy doesn't have the momentum it had in 2023. And so again, if you have that assumption, meaning that you should be a bit more worried about growth and inflation, you could expect, first off, for the first part of the video, the Fed to do more than is what is actually priced in. So leaving aside the price action that we saw as of late, in April, just looking at the 2-year yield, keep in mind, Fed funds rate is currently at 4.33. Between 4.4 and a quarter and 4.5. And really, this is what we continue to see at this point. Even with this decline in February, and right here, you're still basically pricing in a 25 basis point rate cut and a little extra on top. That is it. And so what I challenged in my previous videos, and what I continue to challenge to this day, is the idea that we're going to have just one rate cut. I think we're going to have, my expectation is that we will potentially have more than just one rate cut. How many? I don't know. It'll depend on how offsides, if they are in fact caught offsides, which I think that is a growing risk, given the fact that, as I say many, many times, when the Fed cuts rates and when the Fed hikes rates, you don't get to feel the effect of that in a week or in a month or 3 months. They work with lags, going up and going down. All right, the way I think about it is think a year or 18 months out. When you're positioning interest rates, you're positioning interest rates for the economy that will be in 18 months, not how the economy is right now. If you're positioning rates for the economy as how it is right now, well, it basically means you're late at that point. Okay. Because if you see weakness right now, that means you've been tight and you should have been looser. So, again, I simply think that on the Fed side, meaning on the shorter maturity bonds, treasury bonds, I'm expecting rates to go lower. How much lower? It depends on, again, how offsides they are caught. On the long end, say the 30-year yield. Now, I've drawn this kind of purple box right here because I simply expect that if we do get in, the later stages of a slowdown, meaning that, we get potentially a soft landing or a hard landing, some kind of a landing anyway, some kind of resolution to the economy. I'm not expecting any further declines or like a retest of what we saw in the COVID lows. I think that the COVID lows are behind us. And I think that the area where I would potentially see the 30-year yield decline to is potentially the 2.5 to 3.25 range. And to this, I say, I hear a lot of people argue for the fact that rates can't go lower because we already have a 6% deficit, and the debt is, what is it, 30 trillion, something like that, 35 trillion. And granted, I might still be ignorant on this, so I'm welcoming people to comment and give their thoughts and opinions. Because again, and really, to further elaborate, what is the idea behind the fact that rates can't go lower? Is that the bond market wouldn't accept further increased issuance because we have the government basically flooding the market with increased supply, and the market can't absorb it. So by having increased deficits, increased debt, you're just pushing rates higher. Right, so the more debt you have, the higher the rates go. Again, excuse me again. But what I'll say to that, and again, this is where my ignorance might come in play. But let's go back to 07. Okay. Because this is where rates are right now. They're at rates at levels seen in 07, basically. A time where deficits were lower, and the debt was much lower. What if I told, and you took for granted, took for correct that, that the assumption is that if you blow out government spending and if debts go higher, rates have to, just follow suit, correlate directly with them. If I told you that in 18 years, we'd have the debt explode by, 10 times, 5, 7, 8 times, and we'd be at 6% deficits. And again, your assumption going into that were to be that, again, more debt equals higher rates. Well, if the rates are at 4.8 in 07, and I told you that in 18 years we'd have, the debt at 100 trillion, whatever it is now, 30, I think it's at 35 trillion if I'm not mistaken. Well, your expectation for rates would simply be, man, we're going to be at 15% in 18 years. Because, the market's just going to reject it. There's no way we can go any lower. But again, what happened after that is rates actually going lower. All right. I think that hints to the fact that potentially government spending is inefficient, and it just causes things to slow down even more. They'll give you a sugar rush in the short term, but just looking at what happens in the longer term, rates aren't cooperating with that assumption that higher rates, higher debt equals higher rates. That isn't what the charts are telling us. But again, might be me being a little ignorant and potentially a symptom of the of the sore throat. So on the Fed side, I think that they will end up cutting more, and I think that, as I said in yesterday's video, as time goes on, the Trump tariff drama will take the passenger seat. It'll become noise, because I think that what we saw yesterday was basically a capitulation. All right, you can't put on 145% tariffs and just say, "Oh, by the way, technology is excluded." Yeah, okay. What's left? Soybeans. Great. So, as far as I'm concerned, that is capitulation. And again, it isn't something that I haven't, said it couldn't happen. Because again, it does make him look weak. It makes him look like he caved. And that is exactly what he did, in my opinion. But just because it sounds ridiculous, it doesn't make it, impossible. And that's what happened. So again, I think that from now on, as we move forward, the tariffs will take the passenger seat. They'll become a bit more of noise, and slowly but surely, it won't be a clean and immediate transition. We will see people shift back to the fundamentals of the global economy, and in the case of this video, the US economy, which eventually, in my opinion, will lead rates lower across the curve. And again, this video could be irrelevant by the time I publish it. It could be irrelevant in a week's time. You might have something crazy occur. I have no idea. But this is how I'm going about things, okay? I think that we have to just kind of pull everything together. Yes, it's been a crazy week. But I still believe that the US is the place you want to be it with bonds or stocks. It still has the position of power, in my opinion. I think that a lot of the again, the consensus right now is that, the US is doomed, and we're going to de-dollarize and all of that. And again, granted, it might happen. We might all be trading in, yuan or whatever by the time, a week is gone. But again, I could easily be wrong. So that's basically what I'm saying. But again, I think we will switch back to the fundamentals of the economy. And I think that, yes, there is some truth to, this week has definitely caused some damage. But I think that eventually we will get over this kind of tariff drama, and we'll go back to focusing on the fundamentals of the economy, which will lead the Fed to cut more than people are expecting and have been expecting throughout 2025, leaving out the short-term blip that we saw last week, all right here. And on the long end, I expect the market to, again, focus back on the fundamentals of the economy and actually realize, as we move towards the summer, as I've been hinting at in my previous videos, that inflation fears are overblown, even with this tariff drama, in my opinion, and that growth optimism is misplaced. That is my expectation for 2025. We'll see how it goes. For the time being, if you like this kind of content, consider leaving a like and subscribing to the channel. And I'll go rest my voice. I'll see you next time. Bye.